Welcome to Charting Across the Board, where today we bridge the gap between fundamental analysis and technical precision. I am Marbobsix, your host, and today we have a very special guest joining us, Henrik Zeberg. Henrik is a renowned macroeconomist and market strategist widely respected for his work in connecting economic trends. Henrik, it's such a pleasure to have you here today. How are you doing?
I'm amazing. I feel amazing. It's markets are developing now in a nice way. So thanks for having me on for a chat on about this.
Thank you for joining us. We're again a group of small traders who like to dive into the technicals. However, today we'd like to combine the two of them as you are a macroeconomist to see where we are today. There has been a shift in market sentiment since 2022 at the cycle low to current levels. And we'd like to know where we are today. Where do you see the markets heading between 2025 and 2026?
So first of all, I think if we start off at the market low that you talked about, 2022, where everybody seemed to be so bearish and people are calling for a recession at that point, which was actually very, very clear to me back then that we were nowhere near a recession. So I do technical analysis. But I also work with a business cycle model, which is one where you actually take all the macro indicators in and you massage them technically, and then you will actually get a view on which direction the economy is going. And this is before you start your technical analysis, because if you just start from technical analysis on a chart and with Elliott waves especially, you can make tons of mistakes. So in 2021, I looked at when looking at the business cycles clearly told me that after the Corona stimulus we got, which was gigantic across the world, we still had a push up in the market, and even though the inflation was having an effect on things, and that was really what we saw. It was an inflationary decline, so it declined because of inflation. That's something markets do not like. The markets do not like inflation, not too high of inflation, and that was what we saw. But we did not see an economy in the business cycle that was rolling over. There was nothing suggesting that in my model. So I was extremely bullish back in summer and into the autumn of 2022, and I could see on the extensions, the technical analysis that I did. I said, well, I think we were going up to around 66,000, 6,100 even. And here we are. And obviously now people have been, first they were very, nah, we cannot. And we saw the pullbacks and people saying, okay, slowly, people started to get into it, and the market took off. And if we look at some of the monthly candles and also especially the 3 month candles, we'll see that those are gigantic. Those are the ones that. So when I talked about a blow off top, it was really because I could see that you will have a very strong move higher up to around this level of 6,100. And then now we are getting closer to that. And as we see in every cycle top or cycle bottom, you will always have people standing at the opposite side of where you are supposed to be. I mean, when you start to see yourself amongst the majority of the people, that's when you should start to worry. That's also why you say the stock market climbs a wall of worry, and that is what you need. You need to have that kind of worry into it before you actually will see the market gets going. Because if everybody's already in and bought in and hugely in, then that's a problem. So for now, I'm still bullish, and I have a target right now that is. I just updated that based on what we had technically here with the bottom. I think was just the other day, and I think we have now that last wave up, and I think it's going to be very, very strong. And that will be the very definition of the last spike in the blow off top. So when I talked about the blow off top back then, I was talking about this strong bull market we have actually seen, but obviously also a very strong end to it, and then and a spike into the top. I think that is going to develop now. It's going to develop into the Trump inauguration, into the first few months of his presidency, and then I think we're going to see a top in the market. I think there is a good chance we already have seen the top in a lot of markets out there. So we've seen the top in certain markets in Europe, we've seen in the Nifty, we've seen in the Nikkei, and we potentially also as I see it, seen it in the Dow Jones. So it seems to me now that you're starting to see a rotation of capital into the tech sector, and that is going to be now pushed even higher with Trump taking office. The whole tech narrative that is going to be put on the table, as I understand it, also, and with crypto and the likes. So I think there's going to be a nice spike, a strong spike in tech stocks. I don't think the more traditional industries or the industrial sector of the S&P is going to do, very well. And I think we're heading into a very big top, just like we had a very big bottom in 2022. We will have a very, very big top here in 25, and that's what I see.
That's certainly an incredible demonstration of how powerful these tools can be when used together. And I can certify these that before reaching out to you, I of course did some research, my own due diligence to see where you are standing in the market based on technical analysis. And not only now, because one of the issues that I see as a trader is that some people are often bearish the entire time, right? Regardless of any switch within the market trend, or bullish. So at some point, of course, as a broken clock, they're going to be right at some point.
And you'll be
However,
right or wrong. Yes. Yeah.
Correct. However, when to shift this trend is also very important to identify when that market trend may occur, or that switch in market trend may occur. And not only in 2022, you have been absolutely bullish. You have been when the market was extremely pessimistic back then. You were calling for a bullish, which I indeed did my research. I found your work, and I can certify that that's correct. And not only 2022, however, I also went to before the COVID crash based on your count in the chart, and you were exhibiting a market top also in 2019.
Correct.
November 2018, prior to COVID, even right before COVID even became a thing. However, you were also you have an amazing call back then, also calling for a top that indeed occurred in 2022, correct, or 2020? I'm sorry. Mm-hmm. And then since then we have this new market. However, now the sentiment are starting to become extremely bullish at these highs. So. Many of our listeners are either retail traders trying to navigate these volatile markets. What advice would you give them for 2025 and beyond, without this being a financial advice?
Sure. No, I think it's not about just jumping onto the first conclusion. And very often when you stand yourself amongst the largest crowd, then you need to think, am I really with the right crowd? And that's not what I do. I mean, I base it on the analysis that I see. I base it on markets and bull markets, they last for a certain amount of time, and you have these Fibonacci levels that I use that tells us that we're getting close. And if you look to so many indicators, like why I actually anticipated and expected something of the crash and decline in 2020, although 2019, was that we saw exactly the same we see now. We saw the business cycle having a recession call at that point, and we saw market yields, 3-year yields starting to decline. And we saw also that there was what is called negative divergence on the S&P 500 on a weekly basis. And if you go take a look now, we have all that. We have not seen the yields dropping just so fast yet. They have declined. We have seen the top of it. And that's the only puzzle that I need really to see that really starts to decline. I think maybe this time is it's not very different from the last time, but it's a little different because of the inflation that we have had. And I think also we have passed into a new regime inflationary wise. But I still say that we have the recession indicator, and we have so many things that are deteriorating in the US economy at this point. And I cannot understand when people start to talk about that we have a strong economy. And one of the things, for instance, we talked about a strong market report here on Friday, and so 200, what was it? I believe it's 256,000 jobs. That is an adjusted number. That is after seasonal adjustment. And actually, if you take that away, you will actually see that the number is quite different, very much lower. So that is one thing. It could have been, anything from 100,000 or something like that to 150,000. And we also know that the non-farm payrolls are very, very wrong. Often we saw in November how they were adjusted by 818,000 jobs, removed or taken out of it from the last period. So I don't trust this when they talk about the economy is strong. And this is what I will say to you people and to listeners, is that go look. I mean, there's a famous sentence in the Big Short where actually he says that nobody actually looks, and that is so true.
And no one's paying attention. No one is paying attention.
And if you look at one of the things you can look at is the average duration of unemployment, which is actually a very, very fundamental thing. It tells you about how fast can people actually find a job again. You can actually see that it's rising. It's rising fast. It rose by 5% by the number on Friday, which was a fantastic number according to the BLS before we see the revision. But if you look at the people that actually how long they have been registered as unemployed, you can actually see that it's going up, and that we only see into recessions. So when I have the leading indicators telling me like the yield spread and so on that have been inverted, and we have the largest inversion at all times, and we start to see these things happening, and even though I hear the Fed say it, I don't trust them one bit. So I look at it and I say, what can I see myself? Let me see it with my own eyes. I mean, I'm as intelligent as the next guy, so why don't I just look at it? And then you can see that things are really not as strong as they try to say. So and that fits into the narrative now that we are getting closer to the top of the stock market based on technical analysis, and you'll start to see the divergences. And it's look on the weekly chart on the S&P and on the Nasdaq as well. On the weekly chart, you got negative divergence going. I think it's all the way back to I can remember when it was actually March or something in 24. And we just need the final leg up in my Elliott wave, and that's what we are waiting for. So my target is 6,500. I'm expecting that to be on the S&P, and of course nobody will see, and there will be nobody ringing a bell there at the top. But that's where I think we're going to top out, and then you will not see a decline immediately into it. It's not like of course there'll be a decline, but then it'll come up again, and people say, "Oh, look, now things are going back to fine," and Trump will take care of it. The Fed will take care of it. Nothing. I mean, Henrik, you don't understand the economics and the markets, and then again, it'll take a while before things really start to develop. But I think you're going to see that will actually be the top, and you'll see a very strong decline. And with a market capitalization at this point here at above 200%, which is way above what we saw in 1929, way above the crazy bubble we had in 2000. And we looked at it and we say this was a crazy bubble, and now we have something that is even bigger than that. So when people are looking at these things and then say, maybe I'm now standing with the crowd all shouting, "Oh, all fine, all clear," like they were shouting, "Oh my God, we are falling all the into the abyss now in 2022 and in other times." Just go and look at for yourself, and then check out what is it that you see and why is it that you're bullish. Don't just adopt that. And again, also think like, if you want to go buy a jacket in some shop, then you see it's going up 3 times the price it had, like Tesla, just 90 days ago. Would you then go buy this jacket still, or would you actually think it's actually become rather expensive? Probably you would think it's rather expensive. You see why and that's not how it works with stocks. It's just the opposite. So people think, oh, it's went up 3 times. I gotta buy this one. It's fantastic. And that's just the opposite of what you need to do. You need to buy things when they are on discount and people are running away from it, not when everybody is running into it. And then check out the different Fibonacci levels, obviously, because markets can stay irrational and stay bullish for longer than we expect. I did not expect that we could see into 25. I mean, I'll just say that I expected that we should have seen the top in this before 25. I'll just say that. I'll lay down and say that. For me, it's not about the timing. It's about the levels that we need to reach, the Fibonacci levels, the technical levels that we need to reach. And before if I cannot do the count all the way up and I get my level, then I cannot call it. And then it may be that we pass through a little extra time, but it's not the same as saying it's all off. The thing is that we have negative divergence, we have the recession signal setting off, and it's more about we just get this final push. And I would love to see everybody getting all euphoric now about whatever should come after the Trump presidency or his inauguration and all that, because I think the markets will be markets, and people are just buying into the bubble. That was a little long. Sorry about that. I speak too much.
No. That's absolutely a great analogy, and I believe it's about staying informed and discipline, which is sometimes is easier said than done. As you're focusing on the macro, you're talking about the yield, a rotation within the technology sector, more than we already perceive or experience during 2023 and 2024. Another higher level in the Nasdaq, particularly.
Yeah. I think the Nasdaq. I can't remember. I think I have for Nasdaq. I think we got level of 20. What is it here? I think 24,000. You know, around that level will be the top. So you can imagine that's quite a move from where we are now, and especially with that kind of steepness. I think we can see on it. I think it's going to be a very very steep rally into the final top. So it'll be almost impossible at that time when you reach that to get just a bearish message out there. So I call it my bullshit, oh, sorry, my BS indicator on Twitter. The moments I say, oh, I think something is topped out here, and the more I get of, oh man, you just don't get shit, and you just you're just stupid. The more I get of that, I think, okay, seems like we're pretty close here. So so let's see. I'm very bullish at this point. I have to say it's going to be very very steep, and I think we're going to have a fantastic alt season in crypto. Bitcoin, I got 123,000 as a target around that level for Bitcoin, going into its final phase as well, and topping out later also than the Nasdaq and the S&P, and altcoins even later than that. So I think we will not. The euphoria will persist for some time now, and it can actually persist into April or even May for the alts. But I think we'll see the top in the stock market before that, and especially because there's kind of an anchor for me. The anchor is that we already have seen some of these tops in the rest of the world, the Nikkei, the Nifty, the Dow Jones. I think it could also potentially, I think there's a good chance. And that is as I said, the rotation of capital going from industrial sector into the tech sector, where it's more about, AI, fantastic. It's,
Mhm.
based on FOMO and expectations of future earnings, than it is about how much do you actually produce in terms of, manufacturing goods or whatever it is. So I think there's a fantastic phase in front of us here, and but it's just about getting out at the right time.
That's again a skill that can be developed over time. I believe some of our listeners are new to trading. However, they can apply this experience from your end as a macro strategist, which I'm assuming you're when we're speaking about the macro. Not only the fundamentals, you're looking at the macro within the charts too, where the weekly and the monthly are the larger time intervals when it comes to charting to make this projection. And speaking of projections, I read somewhere that you're calling a pretty bold call that we are going to experience a crash or a market crash worse than 1929. That is,
And that I need to adjust that. That was said one time. I was actually so it was not worse than 1929. It was the worst since 1929. But I am actually fighting against that thing. It was
okay,
one
okay.
headline that
Great.
was made wrong, and then it just persists out there. So, but actually, what I said, and I maintain that view. It's the worst bear market, worst recession and bear market since 1929.
I see. So at least worse than 2008 financial crisis.
Yes.
To finalize the interview, Henrik, when you're talking about yield, are you looking at the 10-year yield as a barometer of economic growth for a decline, or do you see an inversion, an inverse correlation between equities market and the yields rising, the other one dropping? What are your views on fixed income?
So I first of all, it's about the business cycles again, and this is where people are a little set off by what is it actually we need to look at and in which sequence. And there are part of the business cycle. There's something called leading indicators. There's something called coincident indicators. There's something called lagging indicators. And the leading indicators are market yield, are yield spreads. So, for instance, the 10-year minus the 2-year, and so on. And there are others, initial claims and others. Then you have the coincident, which are the ones that actually fluctuate with GDP. And that is labor market, so the NFP numbers, it's the production, and so on and so forth. These kind of numbers. And then you have the lagging ones, which are the ones that follows the economy. That means that when the economy starts to move up, they will start to follow later. When it starts to decline, they will follow later. And that's inflation and yields. So yields are very much attached to inflation, because that's pretty much what what is your expectation of what you need to pay? Well, if inflation is high, you need to have yields that is surpassing that. So what I expect yields to do is to follow the economy. The leading indicators have been declining, have been negative and declining for 20 some months, which we have only seen into the financial crisis. The coincident indicators are actually based on the non-farm payrolls, which I, at this point here, has to say, I think are bullshit. Sorry again, my French here, but I'm just being
I
very
know.
honest with it. I think we're going to see a lot of revision to that, and I think that is I think we're going to see that they are a lot worse than what we actually have seen over the last many prints here. For various reasons. And then you have the lagging indicators, which is inflation, and we have and the yields. And people are mixing that up. So now they start to see, because there's been a yield spike, then they think, oh, it's because yields are coming back, inflation is coming back. That's not what I see. I think what you're seeing here is that when you started the decline, then you have a bounce in these things, and then it comes down further. So I actually see that you are right now seeing a slowing of the economy, which will bring yields down a lot. And if you look at
Okay.
inflation, you actually have the inflation level, which is ridiculously low compared to this onset of other recessions. The last 7 recessions, inflation has been way higher what we have now, way higher. So when the Fed is still, pushing the brakes here, which is, I mean, I don't know what they're looking at, but it seems,
Soft
very
landing.
dangerous. Then you're going to get a hard landing. I can tell you, you do not have a soft landing. I can promise you. And this is what they will envisage. It seems like they don't understand the context of momentum. So if you have a truck and it going right towards the canyon and you want to stop it, I mean, you don't push the speeder to keep, going. You actually start, pushing the brakes here, and you need to counter the momentum that you have in anything. That's like the economy. The economy is a super tanker, and when it starts to turn, we are millions of people, billions of people interacting on a daily basis. We are the truck, and if we want to stop it or we want to accelerate it, we need to start doing something to it at some point. And I think that's actually what the Fed is not getting here. Honestly, it seems like they're looking at levels, and they think they can fine tune the levels of inflation and say, oh, we 2.7, like a chef, just sprinkling the spices on top of it. Oh, we want to do it to 2.0, and I mean, this is ridiculous. That's not how you can guide or steer the economy. And I think that is the the hubris that we're going to see on this, that they think they can micromanage the economy to that degree. And right now, they are still being hawkish, and they are looking at inflation, like what they did in October 31st of 2007, in the quarter where they already had negative, where we had negative growth of 1.6%. The Fed was talking about inflation, and you can go back and look at the FOMC statements there. Again, they do the same again. They're looking at things here and saying, oh, it's like a little too high, and we're a little, and they got spooked because they actually did not see the 9.1 when they,
Yes.
started to stimulate into a supply crisis. So you bring demand up, and because people have to go home, the supply is low. What do you get? I mean, this is 101 in economics. It's that then you get inflation. And that's what they got. And now they got spooked. And now they think, oh, we need to keep it low. And what they're doing right now is that they're standing on that brake, which would be good if the truck was going towards the canyon. But actually, what they're doing now is that they're slowing the economy when it's already slowing. And you have such a drag from all the debt that we have in the world. That's really why we have had the problems with deflation or low inflation for such a long time. And debt is just so much bigger right now. So the Fed is right now conducting the biggest policy mistake ever. And that's why I think you're going to see yields are going to drop a lot at some point. It's going to go fast. But I think we have, and this is where we need to define between what you can call a short-term perspective, medium-term perspective, and a longer-term perspective. And in longer-term perspective, I think what they did under Corona with the stimulus coming out on an extreme stimulus, it was more than the Marshall aid to Europe after the Second World War in dollar to dollar comparison. Then and we had to rebuild all of Europe, and you stimulate the economy, you started to help. This is more we did after Corona, and that was a supply crisis. So when you do that, you trigger inflation expectations, and that is what we have now. And that is why I think we have what is called a secular bottom in inflation, which means that we should now start to look at what happened in the 50s into the 70s in terms of inflation, where you had a bottom and then it went up. And it went up for a long time. It went up for 20, 25 years, 30 years, and then it started to decline again. These are the long-term cycles. So if you ask me what I think is going to happen to inflation and yields, then I'll say short-term into 25, 26, we're going to see inflation going crater. Actually, I think it's going to go really quick. And the Fed will then panic, as they do always, and oh my God, and whatever reason, and they will then come out and fire their bazookas. We are in Q3 or 4 here, but before we get there, but and maybe later because I'm always a little too fast with things. So, but that's what I'm seeing happening here. That we will see yields coming down, we'll see inflation coming down as well, and we will see the Fed coming out and then being scared of deflation again. And that will be the moment where they actually onset the next leg in the long-term secular move in the inflationary cycle. And that's where we need to look into did we actually, what would have been a good investment in the 50s and the 60s, not what we have done in the 10s, so 2010 and 2000 and so on, where inflation was going down.
This is fascinating, Henrik. So you're basically expecting stagflation if you are expecting a lower yields, correct? Can you correct me on this?
Yeah, so I would expect that it will not be stagflation immediately, because the thing is that stagflation is that you have, the two components. Stag will be that you are not stagnation in terms of jobs, and then you have still a higher inflation coming. And that's my second phase of this. So first you'll have a deflationary development. The Fed will come out blazing, and then I think the problem will be for the Fed this time, because people are telling me, Henrik, you don't get this, man. I mean, you've seen it. They just print money, and then everything is taken care of. And then we go again. And that's why I'm saying this time around, I think there is a change, because first of all, people has got hit by inflation. They got hit by higher rates, much higher, for an extended time. And if I'm right, also, they'll get hit by unemployment as well. So now you and I, we will say, okay, the Fed can help us save something on our mortgage. And then we'll take those, let's say $100 here, and say, do we actually go spend this one, or do we put aside for a rainy day? And I think a lot of people will put that aside for a rainy day now, because of those three factors we just talked about. That they will say, yeah, let's see with that inflation, let's see with that yield, the rates, let's see if I'm can get a new job again also, or my neighbor just lost his job, and what would happen to me. So I think that will actually make the stimulus impotent, so to speak. And so it's not going to have the effect that they want, because people are not going to start to use it. And that's what you want. You want the positive spiral. You want people to start using the money and spending the money. And then when they spend it, then new people will be hired, and they will spend money, and then you got going. But if that does not happen, then the stimulus will not happen. And that can then trigger another thing, which is a financial bubble again. And I think this time it can be in commodities, because I think there will start a speculation there. This based on a lot of other things. So in that phase, which is a further ahead after what I see with the yields plummeting, that can be a stagflationary phase. And that's actually the worst kind of crisis we can have, because there's not a lot the Fed can do now, here and then, or the administrations can do. And that is the times where it's really bad for the stock market, and also for bonds for that matter.
Henrik, it's been an absolute pleasure having you on today. Your ability to simplify complex macro trends and tie them into technicals is remarkable. I am certainly not an economist, but I can read the data. For example, you were mentioning leading economic indicators, the yields, unemployment also. I believe today we have unemployment claims. To me, that's another barometer or an indicator to a risk of recession, right? Between a number between 250 and 300,000 should ring the bell for cautionary levels. So I appreciate the time, and our listeners, again, thank you for joining today. If you enjoy this episode, you can share. Henrik, thank you. I know we can go on and on. I believe your passion. There is certainly a clear understanding on economics. Maybe next time, if you're available, we can dive into the technicals if you allow me to have you on again for next time.
Absolutely. Let's do it into the final top, and then see what your listeners want to, if that could be interesting for them.